Warren Buffett is set to step down as CEO of Berkshire Hathaway. He'll be handing over leadership to Greg Abel. But before that change takes effect, we want to look back at Warren Buffett's legacy.
They're too frothy. So when he started Berkshire, this was a profound change because all of a sudden, he's not looking just to make a performance fee. He's looking for permanent capital. So he didn't want to have to deal with redemptions. He didn't want to have to deal with writing letters every quarter and keeping people in or justifying his moves. He wanted somebody to think longer term, and that was a huge shift in his mindset when he got into his 40s. And every scholar of Buffett will look back and say he would have never become one of the richest men in history if not because of this permanent capital structures, right? But more profoundly, it was always really about Geico. I think that we talk about the See's Candy story because it's easier to understand, but he bought Geico and then basically he made all of his policyholders investors because what he got with the float from Geico, you take money in for insurance and then what you don't pay out in claims, you can invest. Well, he was one of the greatest investors of all time, so he had a source of capital that had very, very low cost. It was liquidity that, he didn't have a liquidity problem with investors saying, hey, we need to nab this cash. So his ability to look forward into the future and know how much cash flow he was going to get made it a lot easier to take over companies and to buy things and have a schedule. Nobody had done this up until Buffett. Near his client base, he wanted to make sure that he was selling long-term value. He wanted to be sure that he was the original Bitcoin tout, right? He wanted to make sure that people bought Berkshire and held it forever and never sell your Berkshire. And so not only was the structure designed that way, not only did he have permanent capital, but through his letters, he would talk about moving beyond volatility and not having to think about volatility, talking about a margin of safety. Everything he bought was, a value. He was buying dollars for 50 cents. And on top of that, he was a salesman, right? He talked about underperforming during bubbles and that compounding was really the way. And I think he convinced people that the moats were really about competition. I think that was one of his greatest magic tricks, because really what he invested in through the most part of his life were monopolies and places that didn't have competition and were not based necessarily on the innovation of America, but was based on companies like an Apple computer that just had all the cards. And I think he made people comfortable with that type of, monopolistic oligopoly inside of America. Here's what the thing is. Buffett's legacy is the architecture of Berkshire Hathaway. His legacy is how he did this. Greg Abel, I'm sure, he's a brilliant guy. He knows how to operate. He's been doing it for years, this transition.
Berkshire is not a normal mega cap. It's a holding company with three distinct engines. The first is its operating business. These are companies that Berkshire owns outright. They throw off real cash flow year after year, good times and bad, a Buffett staple. Engine number two is the Berkshire stock portfolio, which probably gets the most attention. It holds big stakes in many public companies, with Apple as the largest. And despite Warren saying that his favorite holding period is forever, there's a decent amount of trading churn in the portfolio from quarter to quarter, and Buffett has slowly given up control over its stock-picking decisions since 2010. Engine number three, and this is the quirky one, is Berkshire's insurance business, including what's called the float. Insurance companies collect money from premiums first and they pay claims later. And that in-between float money can be invested. That's a structural advantage that many companies do not have, and it helps explain why Berkshire can afford to be patient when others cannot. Now, let's check out a Berkshire stock chart. And here we're comparing Berkshire to the S&P 500 over the last 5 years, which includes several market cycles. And you can see Berkshire's up 120% versus 80% for America's benchmark index. And you can credit the higher return to Berkshire's ability to hold up better during both the 22 bear market and during the post-Liberation Day sell-off earlier this year. And while the rest of the market started soaring in mid-April at the right of the chart, Berkshire has lagged a bit, and many credit the overhang of Buffett's departure, which only means that 2026 could be a defining year for the conglomerate. Now let's take a look inside at the many businesses that make up Berkshire's own mini real economy. Starting with Geico, their insurance business provides a real-time risk on risk pricing across the world. And through its BNSF Railway, it gauges freight, shipping, and industrial demand. And Berkshire Hathaway Energy, not surprisingly, gives a read on the energy markets, including business investment spending and the power grid. In manufacturing, it has Precision Castparts, which provides a window into aerospace and industrial orders and demand. And Berkshire has a bunch of household brands, from Dairy Queen to Fruit of the Loom to Brooks Running Shoes. Along with its McLean Supply Chain Services business, it has many eyes on the health of the consumer. Finally, from services like flight safety, it gets business travel and training insights. So Berkshire doesn't just track the economy, it lives inside it. And then it brings to us that next question: what happens next? As 2026 kicks off with Abel at the helm, we're going to want to pay attention to Berkshire's capital deployment, as this is always the game. When do they move? When do they sit on their hands? Because investors have been wondering for the last decade when Berkshire will shell out cash for a big buyout. Will Greg Abel be just as willing to wait for the fat pitch? Meanwhile, that cash pile sits north of $300 billion, and it is growing. Next up is stock buybacks. Buffett has always been clear. He's only going to buy a stock, including his own, when the price is attractive or wonderful. So watch that closely. Then there's insurance discipline, the quiet engine. If that stays tight, the whole machine stays healthy. And finally, watch the communication tone and listen to that. We might miss the marathon Q&A sessions and watching Buffett hold court for hours like a folksy oracle behind a can of Coca-Cola, but clarity is what matters.